I'm joined by Michael Hudgins, Global REIT Strategist with J.P. Morgan.
Recapitalization was the story of 2009. Is that going to continue in 2010?
Absolutely. I would make one distinction, though. In 2009, a lot of the equity issuance and recapitalization was done to pay down debt, to simply de-lever. For some stronger REITs, it was to build cash hoards. 2010, I believe, and moving forward, we'll continue to see equity issuance, but done in conjunction with efforts to create value. Right? This is a key distinction. What I mean by that is we will see more and more equity issuances deals that are done in conjunction with acquisitions.
And what about the trend towards blind pool REITs? Will we see more of these?
When the market believed that we would see distressed values, distress with a capital D, I like to call it, blind pools made a lot of sense. You invest your money with a good management team, they can put that money to work for you, and the returns, because the values were expected to be so low, the returns would justify putting your money in a place where essentially it would earn no returns until the money was put to work, whether that took months or even years. Right? However, I think that the expectations now are increasingly leaning toward a market that is more competitive, where distress, if we see it, will be with a lowercase d. And as a result, the blind pools make less sense.
And you alluded to trends in pricing. There's been some data that has shown that high-quality assets have stabilized in terms of their pricing. What's your take on this?
I've seen the data. It does suggest that high-quality assets are stabilizing at a place where cap rates are maybe 6 to 6.5%. I think that's actually going to help. I think it's going to get the ball rolling, actually. And let me explain why. I believe strongly that the reality is we're not going to see the big distress. We're going to see the distress I said earlier with a lowercase d. If that is indeed the case, REITs and other buyers, other investors in real estate have to get their heads around that. They have to come to grips with that. It's going to mean lower cap rates. It's going to mean lower IRRs than they had hoped for, though still probably some of the best we'll see for decades. Given that reality, if they're able to come to grips with that, to make the acquisitions, all right, they see the clarity, they have the clarity, they see that prices have bottomed, they make the acquisitions. I actually believe that in this more competitive environment, that REITs are more advantaged. Why I believe that? One, their management teams are very savvy. Most are very experienced, very savvy. They will be looking for these deals and be able to source these deals. All right. Two, they have access to capital. All right. Three, they have access to various types of capital, whether it be convertible debt, preferreds, equity, unsecured bonds, which would allow them to creatively structure deals in a way that can take these still very good cap rates and IRRs, but lower than expected, and still come out with some real value add for their investors. But moreover, if you look at the cost of capital for REITs versus their competitors right now, it's very competitive.
Okay, well, thank you very much for joining us, Michael.
Thank you for having me.
For more information on this and other REIT news and analysis, check out REIT.com.